Good morning, everybody. This is the live market open for Monday, February 29th. We have February 29th only every 4 years or so. I'm Yohay Elam, Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. As usual, talk about what happened in markets recently. Friday was quite a busy day, and also over the weekend we had quite a few developments, some charts and levels. We have new positionings, and the next 24 hours, which are expected to be busy, the end of the month and the beginning of a new month. And as always, most importantly, look forward to hearing your questions. Good morning to everybody in the room, Fabian, Adinda, and I see quite a few of you over there. If you cannot see the chat box alongside the video, please go to the address on the screen here, tlk.io/fxread-forex-live-video. So, as we usually do recently, we'll talk about the market mood. Okay, first of all, we had the G20 summit over the weekend. We had finance ministers and central bankers meeting in Beijing or Shanghai. Anyway, it was in China. We had a few headlines coming out of there, but they fell short of really taking decisions that would ignite the global economy. So what did they agree on? Let's back the camera, maybe it'll be easier to explain it this way. First of all, they did decide on that what we're seeing in markets in recent months is an exaggeration of the actual situation. Okay, so they don't think the situation is as bad as markets see it. Okay, they did say also that monetary policy cannot do everything. We already know that. We already know that monetary policy did a lot. Okay. Negative interest rates in Japan and in Europe, and well, QE programs, and well, we won't talk about all that. But they did say they should be supportive. They said that if countries would enact policies that could weaken their currencies too much, they should warn each other. Now, in the past, they decided to refrain from any kind of competitive devaluation. This time, they're sort of allowing it, but please warn us before you do that. Some supported, some said that countries should do more structural reforms. Some said that more fiscal stimulus should be introduced, but there was no agreement, absolutely no agreement on any real policy action. Okay, so basically lots of words, but and they did talk about warning about devaluation. They did try to say the situation isn't so bad, but didn't take action. Among the things they warned about was the Brexit. Okay, so now it has become from an internal UK event to one that affects also Europe, of course, to one that is a risk for the global economy. We heard the finance minister of the United States, Treasury Secretary Liu, say that it could have implications. We also heard the IMF say something like that. I think also the Chinese. Anyway, now lots of pressure on British voters to stay in, coming from all over the world. Critics from the Leave campaign in the UK said that the government is bringing everybody on board to create this fear campaign to push Britain out. Anyway, Brexit is now far more than only a concern for the pound. Okay, but basically, in terms of decision making, bottom line, lots of talk, no real decisions. Okay, let's continue with what else we had over the weekend. And in general, we had elections in Ireland. Well, we have strong economic growth in Ireland. The people are discontent with the austerity measures in the past few years. They didn't really vote out the government and select a new one, but there's a hung parliament, and there's also uncertainty over there. Remember, we're more than 2 months after the elections in Spain, and there's still no government. Okay. This morning, the mood is damp in China because we have another fall in stock markets. It's different from the positive mood we had on Friday. We'll talk about the events on Friday quite soon. Specifically about New Zealand, we had a few weak figures there. We'll talk about that soon as well. And now we're talking about a rate cut in New Zealand. Okay. You may see your comment. Best way to trade G20 news, believe the opposite of any statements and you should be on the right track. Yeah. Japan said that other day, never, no way negative rates a week. Later, Japan went negative. Yeah, I can even add to what you said regarding the Swiss National Bank said a few days before they they removed the peg back in 2015. Early that this policy is going to stay for a long time, and then in one moment, it just disappeared. Anyway, let's go back to Friday. Friday was quite a busy day in terms of figures. In Germany, we had inflation figures trickling all over the morning, and then when we had the final release, we learned that Germany fell back to deflation, okay? Bad news. According to the European standard HICP, the Harmonized Index of Consumer Prices, what matters for the whole Eurozone figure that we get today, it was negative, okay, 0.2. According to the national figure, it was 0%. That hurt the euro. In the United States, GDP surprised with 1%, better than expected. It was expected to fall to 0.4, 0.5, but it included less consumption and more inventories, not the best components for growth, okay? But other figures were quite okay, okay? The Fed's favorite inflation figure, Core PCE Price Index, good morning, Sinatra as well, rose 1.3% year over year, better than 1.2 expected. Also, other figures were positive: personal spending, personal income, and even the final revision of consumer sentiment, they all beat expectations. Okay, as aforementioned, New Zealand data doesn't look so good. It was business confidence and building consents, building approvals. They were both negative. Also in Australia, the data wasn't good. Corporate profits are falling. And the S&B, Thomas Jordan, we mentioned him before, is ready to adjust policy regarding negative rates. So Sinatra left Barcelona, have not been, brought you a cake. No worries. See you perhaps next time. Anyway, let's look at the charts before we move to today's events. I can already a lot of time without showing one chart. So here we have euro dollar. We talked on Friday and also on Thursday about this very, very clear range between 109.60, I would say, yeah, here would be a better approximation, to 110.70. On Friday, we had the negative news from German inflation. We had relatively okay news from the United States on most fronts. We finally, at the final hours of the week, we had it break down under, 109.60, falling close to 109, 109.10. This morning, we're seeing euro dollar recover again, but I would say failing to break above 109.60, okay? So in the past few minutes since we began the show, it began sliding once again. Anyway, it did recover just a bit from the big fall on Friday. I would say this is a correction to, we had a fall we had a fall in the late hours on Friday and thin liquidity. And then in the early hours, also in thin liquidity in Asia, we had it recover. All in all, it's in the same range. Well, now sliding 109.48. Okay, further support is far lower. I would say only at 107.70 and very strong support at 107.10. Okay, but anyway, we're back to the downside. All right, let's move to other currency pairs. The pound. The pound was further hit on Friday. Reached new lows, 138.50. Again, the lowest level since March 2009, so it's nearly 7 years. Currently, there was some recovery attempt. We went back over the previous low of 138.80, and now we're flirting with 139. Very weak resistance at 139.60, more or less. 140 remains some kind of resistance, even though we had a small break above this line beforehand. Okay, so these are the current levels. 138.40 is the low. This could serve as support. You'll add this line. Perhaps we already have too many lines here, but these are the lines to watch. Of course, headlines from the UK regarding the Brexit remain dominating force. It doesn't mean it's a one-way street, but we always have action. Dollar yen, here we see a full reversal. We're 1% down on the day, over 100 pips here. So We went all the way up to 114, yeah, almost 114. Time to update this line. Above resistance at 113.20, which I mentioned last week, and now we're back down again. The Japanese yen is strengthening alongside the falls in Asian stock markets, especially the Chinese one. Also, actually, the Japanese one is falling. The risk-off sentiment is giving a boost to the Japanese yen. So that's what's going on with the yen. The Bank of Japan probably had some fun on Friday, but now we're back down. 111, remember, it's a double bottom. Okay, so very, very strong support here at 111. 114, I would say resistance, followed by 115.25. Okay, let's continue. Dollar CAD. So dollar CAD fell to new lows on Friday because we had a falling oil prices. 134.60 remains the very, very strong support line because it was strong resistance. We're keeping a safe distance from this line. On Friday, it was just above 135. Now we're moving a bit up, so I would say looking for a new direction. But on Friday, we had a rise in oil prices, so we had a rise in the Canadian dollar. Okay, here we are with oil. We had a break to higher ground, closer to 34.80. Look, it's the previous highs. This would be a more 34.84. So we had it continue advancing, 2 steps forward, 1 step back. Now we're clearly falling back. Worse atmosphere because of what's going on in Asian stock markets, but finding here some support 32.25. This is WTI crude oil, West Texas Intermediate. Okay, Brent is usually a bit higher, not that far behind. The Australian dollar, I would say it's trading in ranges. Now we fell down. Falling stock markets in China, weak corporate profits in Australia, so we're back under 71.40. Okay, I like the way that this pair respects the lines. Okay, it breaks above, breaks below, but it sort of trades in ranges either above or below. So it's 72.20, 72.80, 71.40. Into the downside, I see only 70.40. We'll talk about events coming up for Australia quite soon. The Kiwi was a real hero on Friday, or late last week in general, because we had a few positive figures, better mood in markets. We had a break and almost reached 67.90. We went above this range. Look, it traded in range for quite a long time, but then new week, towards the end of the week, it fell, and then it opened with the gap lower. Worse business confidence and worse building consents. So yeah, we're on lower ground. Need to update these lines here, but yeah, I would say 65.50 is still some kind of support. Wider range 65.50 to 67. Okay, let's continue with the Swiss franc. Battling under parity. Parity works as resistance. Currently at 99.70. 98.50 works as some kind of support. Euro Swiss still under 110. We had this suspected support of Swiss National Bank to keep the pair above 110 at some point. Now we're back below 109.10. Maybe we'll see some intervention now that the pair is slipping. The euro is weaker against the dollar and also against the franc. Slightly weaker euro and some kind of stability on low ground for the pound means that so far the assault for euro pound is waning. 79 here, 79.30 more or less is a resistance for the pound. We're back under 79 cents. 78.70 is support. Okay, so we're in a high range, but we're certainly off the highs in euro pound. Euro yen, we talked about how this pair is no longer this sort of pair of safe haven currencies because the euro is a bit less safe. We had some kind of recovery because the yen weakened a lot. It went all the way to 125. Now we're back to 123.60. Support is at 122.40. And last but not least, pound yen. Also here we had it fall to 154.66 as support, and we had it rebounding mostly on the weakness of the Japanese yen, not on the strength of the pound because it doesn't exist. So 157 at the moment. The round number of 160 serves as resistance. Okay, so we covered all the regular currency pairs we wanted to cover. I'll talk about the events we have today, and of course looking forward to your questions about currency pairs, about political events, about whatever you wish. Okay, so we talked about these are yesterday's events. Yesterday was Friday. Let's talk about the busy schedule for today, the last end of the month, and also the wake of the new month in the Asian session that will come. So at 9:30 GMT, we have net lending to individuals in the UK. Not so important, a second-tier figure, I would say, but shouldn't be dismissed. Okay. Yeah. So we're expecting there. No, we don't have expectations. Last time it was positive 4.4 billion pounds. Let's see what we have this time. Let's mention before we move forward the events we had earlier. So this was a big disappointment for Australia. The fall in corporate profits, more than expected, 2.8% instead of 1.8. Okay. Other figures were quite mixed. This was the most important one. Earlier, just before the show, we had the figures coming out from Germany. So retail sales year over year fell 0.8. They were expected to rise. More bad news from Germany, at least month over month, they rose 0.7. So perhaps you can say a bit mixed. But regarding the ECB's mandate, inflation, import prices fell a lot, 3.8% year over year, worse than expected. Also month over month, worse than expected. So we talked about British figures. Let's talk now about what I see as the main event for the morning, a top-tier figure for the Eurozone, Consumer Price Index. So after we had a terrible release on Friday from Germany and worse than expected from Spain, now we get the all Eurozone figure for February. This is the last inflation read before the all-important ECB meeting next week, March 10th. And on the headline figure here, we're expecting 0% year over year, okay? After 0.3 last time, according to the updated figures, remember it was downgraded from 0.4 to 0.3. Now we get the preliminary figures for February, expected to show 0%. I suspect that we might even have a negative figure here, okay? We might even have minus 0.1, minus 0.2, headlines screaming, Europe is back in deflation. Yes, it's because of oil prices, but also core figures are not looking that well. On core figures, we had it at 1% last time. This time it's expected to slide to 0.9. But I remind everybody once again, the mandate of the ECB is headline inflation, not core inflation, okay? So we're expecting, of course, expectations are already low because of Germany's, the German figures on Friday, but look at the charts. We had some kind of recovery on euro-dollar this morning. Okay, it's already being partially erased, and we might see it fall even further, especially if we have a negative number. Does this mean another 10 billion in QE for the ECB or another 10 points, basis points cut from the ECB? I don't know. I can't quantify how much it means, but it's more pressure to act and to do more. Okay, so if we have, of course, a positive surprise, if we have inflation coming out at 0.1, for example, then we could have some kind of relief rally. Again, for euro-dollar, it's 109.35 at the moment, so 109.60, 110.70 on the top side, 109.10 on the downside, but really strong support only at 107.70. Okay. What's next? U.S. pending home sales, and before that, some Canadian figures. The Canadian current account could have a small impact on the Canadian dollar, expected to show a big deficit. Pending home sales, not the most important housing figure. We already had other figures last week, but still worth mentioning, could move markets just a bit. No consensus here. The Chicago manufacturing, the purchasing managers index. It's an early figure. It's preliminary for February, but doesn't, well, anyway, as fall is expected, we already know that manufacturing is poor. Okay. Any questions? Okay, I want to talk now for those of you trading at night, because we have really, really top tier figures in Australia, in China. So let's move to tomorrow. Yeah. Hope everybody's already familiar with the FX Trade calendar. Here it's being shown on Forex Crunch. Anyway, we have, first of all, for a warm-up in Australia, we have the current account balance expected to show a big deficit, and the building permits expected to drop as well, adding some pressure on the Australian dollar. But that's sort of, these are important figures, but they come on a day when we have even more important ones. So we have at 1 GMT, 1 a.m., 2 a.m. here in the old continent. Manufacturing PMI from the government. Oh, that's non-manufacturing. Also important, but more important figure, let me show you this, is, okay. Manufacturing in China, in the world's second largest economy, according to the government, it was just under growth. 50% is the threshold separating growth from contraction. A small drop from 49.4 to 49.3 is expected. But that's the government. The independent one looks even worse, 48.4, slightly more significant contraction, expected to fall to 48.2. Any deviation from this figure, either up or down, has a significant impact on the global mood. If we have better than expected figures, China is okay, stock markets are up, commodity currencies are up. If it's negative for commodity currencies, negative for oil, negative for stocks, positive for the yen. Okay, so this is a very important figure, first and foremost for Australia, but certainly not only for Australia. And at 3:30 GMT, we have the rate decision from Australia. No changes expected to remain at 2%. Okay, so we're not expecting anything there because the RBA told us that, but I see your question about that, and let's put some details. So in Australia, we have a interest rate at low of 2%. It hasn't, in the first rate cut cycle, we didn't reach such low levels, but we did reach it more recently. In general, the Australian economy, if it looks inwards, it's not doing that bad. Unemployment is down. Other sectors are picking up, enjoying the weakness of the Australian dollar. Housing might be in a bit of a bubble, but at the moment it hasn't burst. But when you look outside, look at China, and you see issues over there. Of course, China is still growing, but not enough to feed, not enough to buy all the iron and copper that Australia produces now at full capacity. Okay, so these are that's general about the Australian economy. What I did read recently is that RBA is not expected to cut rates this time, but given the slowdown in China, given other global worries, given worries that maybe the strength in employment is going to dissipate, then we could have the Reserve Bank of Australia decide, not this time, but later on this year, maybe even next month in April, to cut interest rates. So I don't think, to answer your question, I don't think there's going to be a cut. If there's going to be a cut, of course, chances of a hike are zero. If we have a cut in Australia, it's going to be a big, big blow for the Australian dollar because it's not priced in. So if we're currently at the 71 handle, I think we could easily fall below 70 cents, okay? Easily, 69.40 is support, followed by 68.30. But this could be a big impact because the expectations are the expectations for rate cut are very, very low this time. What is a more realistic scenario is no cut today, but a hint of a rate cut in the next months, sort of less neutral mode, more worries. Okay, so we cannot totally rule out rate cut today, but it can happen, and we can have a negative shift in sentiment. Okay, this is of course also a big event for Australia, coupled with the Chinese PMIs. It could be quite an explosive night or morning over there in Asia, or evening in the United States, depending on where you are. Okay, so let's move back to the other events we have today. Well, at night, just before we wake up here in the old continent, in the UK, wherever you are, and we have a speech from Bill Dudley, number 3 at the Fed, the president of the New York Fed. He leans to the dovish side, and let's see how he sees the recent figures. Remember, last week, figures were not that bad in the United States. We had better than expected durable goods orders for a change. We had better than expected existing home sales. New home sales were bad, but better personal spending, better personal income. So all in all, we had positive figures. And let's see how we react to that. Nobody is expecting a rate hike in March, but I want to show you the implied probability for rate hikes. Of course, in March, it's still totally negative, 12% only chance for rate hike according to bond markets, but it's still up from levels we've seen beforehand that were around only 5% for a rate hike. Okay, and if we move forward, we can see that chances, of course, are rising as we move along the timeline. And if we go all the way to December, we see that in December, according to bond markets, 1 rate hike is priced in. That's very far, and that's only 1 rate hike. And the dot plot talked about 4 rate hikes this year, which seems quite unrealistic. But this is a change. Bond markets are a bit more optimistic on the US economy, a bit more optimistic on the Federal Reserve. Okay, so let's see if Bill Dudley is also a bit more upbeat. So inflation figures were a bit better. I forgot to mention that, so that will be an interesting development to watch. Okay, in the meantime, as I continue speaking, we have Eurodollar sliding from that resistance line of 109.60 to 109.30. Let's see. Yeah, erasing previous gains. Okay, if we look at the pound, so the pound is sliding, try to settle above 139, but it's now back down. Yeah, in general, we're seeing some dollar strength across the board. I must say it is some kind of a relief to see the dollar moving higher or lower across the board, and not this risk on, risk off move that we've seen so many times. Okay, don't think it'll last too long, but it's nice to have it. Anyway, any more questions? I hope I answered that question about the Australian rate decision in detail. So, quite a busy day, the end of the month. Yeah, okay. Have here a question from Sinatra. Trading Aussie dollar trading in a rising wedge since the beginning of 2016. So thanks for sharing the chart. Let me share it with everybody else. Nice chart. Thank you, Sinatra. So yeah, we have Aussie dollar rising here alongside this uptrend support uptrend support line, but it's capped here by resistance. Now, according to these waves here, you could see another move up, but another cap under resistance, another move towards support, and a last attempt to break resistance, and then a total collapse, right? Technically this makes sense. Fundamentally, I also see weakness in the Australian dollar because of worries about China. So we could see it fall. Indeed, I'm not sure we'll have two more attempts on high resistance, but let's see where it goes. Yeah, it might not go swiftly up like that. Yeah, that's also what I think. Yeah, we'll have to wait and see. Anyway, tonight is a big night for the Australian dollar because of China, because of the top-tier Chinese figures and the top-tier Australian event, the rate decision. Okay, if we have a hint, for example, on a rate cut next month, or of course, a very, very surprising and unpredictable rate cut, anything can happen, then we could have it collapse already in the next 24 hours. Okay, less than 24 hours. Okay, anyway, thanks for this very interesting chart. Any more questions? I'll mention other events this week. Yeah, let's talk about the pairs to watch for today. First and foremost, euro dollar. That's very easy because if we look here at the what I pointed out, I think any deviation from expectations for 0% on eurozone inflation could be very significant for euro dollar. So euro dollar is a bit edgy, a bit nervous. So if we have eurozone inflation fall to deflation, fall to negative ground, then perhaps we could have another break to the downside. That's a clear focus to me, and especially as the ECB decision is getting closer, and the uncertainty in Spain and in Ireland. So this is the main period to watch. Okay, this morning, and then at night, of course, it's the Australian dollar with this with the two PMIs from China and the Australian rate decision, and of course the pressure is on. I mean, the tension on the Australian dollar begins already now. Of course, it doesn't. Markets don't always wait for events. Another question here: you think oil will rise more? It is still oversupplied, so it could be only correction. Yeah, I'm still bearish on oil because of what you said, oversupply. So we'll have a meeting at some point between OPEC and non-OPEC members to discuss some kind of production freeze. The good news is that they're talking. I mean, good news for oil prices. The bad news is they really don't trust each other, and there's just too much oil sloshing around markets. So any rise, I see it as a correction. At some point, of course, something will have to give, something will have to happen, because if oil prices are lower for longer, then some production has already become unprofitable and will have to shut down. Eventually, also lower inflation lower oil prices also leads to more demand. A country like India, for example, they depend more on services than on manufacturing, and their economy is growing quite strongly. That means they consume more gasoline. Okay, and now it's cheaper. I mean, I can buy a gas guzzler in the United States and drive around, and it's cheaper. But these processes take a long time to mature. And also the lack of investment that we're seeing in oil takes time to mature. In the meantime, we have oversupply, not enough demand, and ongoing pressure. When will we have a turning point? Many people talk about the second half of the year. Yeah, could be, perhaps not. For me, what seems more certain is that in the next few months, we're going to have ongoing pressure on oil prices, okay? Many more questions? In the meantime, yeah, euro dollar continues its slide. And I'll talk about other events we have this week. Very busy week. Today, yeah, I also highlighted eurozone inflation as one of the key events for the week. And of course, at night we have Chinese PMIs, Australian rate decision tomorrow. Talk about this, of course, in much more detail tomorrow. Canadian GDP, the last one for 2015. ISM manufacturing PMI in the United States, the first hint for the non-farm payrolls, and another look at the struggling sector. Okay. On Wednesday, GDP in Australia, and in general, it's a very, very busy week for the Australian dollar. Rate decision, GDP, and key Chinese figures. We have on Wednesday also the ADP non-farm payrolls, private sector report that is a hint for the non-farm payrolls on Friday. As always, oil inventories remain the star because it impacts all currencies. Thursday, US jobless claims and ISM non-manufacturing PMI. The services sector might have joined the manufacturing sector in going to contraction, at least according to what we've seen from market. Let's see if the more important figure ISM confirms this. And on Friday, Chinese trade balance, of course, levels of imports and exports, and needless to say, US non-farm payrolls. Okay, another question here. Odd dollar or odd yen, which one you think will be more reactive? I think the Aussie against the yen, because the yen is still safe haven currency. Of course, less popular than Aussie dollar. These crosses are always less. Where did that currency pair escape from me? I'll just take a look at that. Why am I mentioning? Why can we see perhaps a stronger reaction on Aussie yen? Because if we have a bad mood in markets, then we have the yen strengthening and the Aussie falling. When we have while the dollar does not strengthen so much when we have a bad market mood. Then the other way around, if we have a good market mood, and then we have the yen weakening and this Aussie dollar strengthening, again, the yen moves more on risk events than the US dollar. So we could see bigger moves here. Support somewhere there just under 80 at 79.70. Resistance. This looks like a very clear line of resistance at 82, right? So we do see here perhaps lower lows. It's hard to say lower highs, but these are the levels to watch: 77.45, 79, 70, 82, and 83.50 are the levels to watch here. If we have bad Chinese manufacturing PMI and warning from the Australian Central Bank, from the Reserve Bank of Australia, that they're going to cut rates, then we could see a big collapse in this pair. If we see okay figures from China and sort of no change in the RBA's statement, nothing to see her move along type of a statement, then we could see a big rebound. Currently, we're bang in the middle of the range. This range between 70 and 82. Okay. Hope that answers your question. Any more questions before we reach the wrap up for the week? The day. See if I didn't forget any kind of event this morning. We have the Swiss leading indicators. As always, these events don't move anything. Perhaps worth mentioning that alongside the Eurozone inflation figures, we get the same figures from Italy, which are unknown, and it's the third largest economy. But of course, the Eurozone figures have more of an impact. Question here: market seems happier with the stronger dollar. Yes, market seems happier with the stronger dollar because we had in general better figures from the United States in recent, I would say, in recent 2 weeks, and it's important to remember that the United States is still on a tightening path, a very, very mild tightening path, but it's very different from the Eurozone, which is expected to introduce more stimulus, and Japan, that is expected to introduce more stimulus, and the UK, that is sort of reversed, not going to cut rates, but certainly the rate hike has been pushed back into the future now with the Brexit fears. And what other major countries? Swiss National Bank is considering adjusting the negative rates. Australia might cut rates. Canada is suffering from lower oil. So you name it, the United States is still leader, perhaps a weak leader, but it's still moving forward in terms of tighter monetary policy. Okay? And as I've shown you, the high probability for rate hike has, for a change, become positive for this year, which is still, bond markets are very dovish, but less dovish than they used to be. Okay. So this is the wrap up for the live market open for February 29th. It's Monday, the end of the second month of the year, and a very busy day in general. The market mood is not so good. G20 decides one meaningful thing, that countries should warn each other when their policy could cause devaluation, basically allowing for some devaluation. But but they didn't decide on any meaningful steps. I don't think it was totally unexpected. Usually they just sign on these nice statements which don't mean anything. I mean, let's help global growth, and how will we do that? We never know. Hungary Parliament in Ireland doesn't add to positive, doesn't make things better. Chinese stocks are down, Japanese stocks are down. Worse than expected data from New Zealand. So market mood is a bit worse today. It's quite different from what we've seen on Friday, because on Friday, in the United States, we had slightly better US GDP. The Fed's favorite inflation figure beat. Other figures were positive in the United States. But in the Eurozone, Germany fell back to deflation. That feeds into today's figures, and that has had a negative impact on the euro. Okay, so let's look at the charts before we mention the events. Charts show us that euro-dollar resumed its falls. Yeah, it made an attempt to recover. The Friday's losses went all the way to resistance at 109.60, and then it's falling once again. 109.10 perhaps is weak support, followed by 107.70 and 107.10. High resistance at 110.70. I'm happy to see that euro-dollar is trading more in a better technical manner. Pound dollar suffered from the Brexit talks, which also were on the agenda of the G20. Everybody warned how Brexit could damage the global economy, not only Britain. Anyway, 138.70 is the current level. 138.40 is around near 7-year low. 140 is resistance. Dollar yen, slightly worse market mood means that the pair is falling, that the yen is strengthening. 114 was the high when things looked better, and now we're under 113. 111 is a very, very, very strong line. It's a double bottom. Okay, dollar CAD, still the Canadian dollar still looks better because oil is still okay. 135, very round number, is support. 136.20 is resistance. Better oil prices help. Australian dollar is significantly lower on worse corporate profits. Worries about China. Worries about if the RBA could hint about a rate cut or something like that. Ranges, the lines to watch are 70.40, 71.40, 72.20, and 72.80. Kiwi dollar was, now it's recovering just a bit from support at 65.50. Still within the range. It made a move above the range last week, but it's back down once again. Business sentiment and building consents, both badly disappointed. Okay, let's talk about the events for today. We have net lending to individuals in the UK. Should have some impact, not too much. Political concerns are left front and center. Eurozone inflation, key figure, expectations are for 0%. That means 0.1 could help the euro recover. Minus 0.1 could push it even lower. We're 10 days from the ECB's decision, and the tension is very, very high. At 3 GMT, US pending home sales, 15 minutes before that, Chicago PMI, both are second-tier figures, but we move from second-tier to first-tier, top-tier figures. In Asia, we have the Chinese official PMI at 1, expected to show moderate contraction. The independent, the Caixin PMI, manufacturing PMI, expected to show a bit more significant contraction. It has a big impact on the global economy, on the mood. Really, really important. We'll talk about that tomorrow, of course. Australian rate decision at 3:30. No changes expected in the outside chance of a rate cut. The Aussie will collapse. But we might, more realistically, we might get a hint about a rate cut in the next meeting or the following one, okay? And perhaps last but not least, Bill Dudley of the Fed speaks at 4:30 GMT. Let's see if he says something meaningful, if he sees the glass half full or half empty. Okay, so before we move towards the exits, let's see if we have more comments here. Getting bored with the Grexit, it's all hype. Grexit, Brexit, who's next? Yeah, Ireland, that now we don't have, we have uncertainty about the government. Yeah, oh, thanks, Artem. Link rate hike probabilities in Australia, if someone needs that. Great stuff, thank you very much. So let's see how these probabilities change tomorrow. Okay, very nice how it changes over the trading days. Thank you very much. Very, very useful. Really glad when we help each other. Yeah, got my exits mixed up. Why can't we all just get along? Yeah, eventually I think the Brits will decide to stay in, but even though, despite all the big problems in the European Union, I hope everybody gets along in general. So thank you very much, everybody, for coming, for the great questions, for the great charts and information. I wish you all a safe and successful trading day. A nice ending to the month. One thing perhaps I forgot to mention, it's the end of the month. That means we have end of month flows. That means we could have some weird moves in markets, but things will get back to normal tomorrow. A new month and the following days are expected to be very, very busy. Okay, so that's it. Thank you, everybody, and see you tomorrow. Bye-bye.